So this is our second to last class. Our last class we'll be doing an exam review. So just a couple of cleanup items. There's a little bit more in the notes if you want to read through the end of the notes. Some of it applies a little bit more to the property and casualty side, so I'm not going to hit it as much as I do in that class. But I want to do a little discussion on, if you're interviewing with an insurance company, just give yourself some understanding of what would be a good way to analyze a company, a life insurance company. What ratios should you look at? What kind of issues should you look at? I'm going to take from the standpoint of a rating agency like Standard & Poor's and Moody's, which is a good analysis even if you're a stock analyst or a bond analyst, or even just looking out for a company that you want to do a long-term product with. You want to make sure they're a secure company. What kind of analysis you do, and then a quick hit on insurance regulation. Extremely important with insurance that you understand the regulatory framework, because insurance is a heavily regulated industry. You saw that some in your discussion on paper 2, how healthcare itself is heavily regulated, health insurance is heavily regulated, and so we can't do a class on life insurance without at least addressing regulation. So let's start with on page 75 of the notes, just how would you go about analyzing a firm. And so I'm going to do this from a rating agency standpoint. There are a few firms out there: Moody's, Standard & Poor's, AM Best. I think Weiss is still in business. I haven't checked in a while. Duff & Phelps, Fitch. These are rating agencies. They rate the debt of companies, but they also rate on the financial services side only. They rate the actual company itself. They rate the company. So it took me a while to figure this out. When I first got into the investment side, I would call S&P or Moody's and ask for, say, what's the rating for IBM's debt? And they would ask me, well, what debt are you talking about? Which piece of debt? Because there was senior secured, subordinate debt, commercial paper, and I wouldn't even know. So I would just have to hang up and try to figure that out. But if you call on a life insurance company, a property and casualty insurance company, a bank, you can actually get a rating of the entity itself, and they call it the claims paying ability rating for insurance. I can't remember what they call it for banks, but it's the claims paying ability. So they're essentially looking at the firm from the policyholder standpoint. What is the ability of this firm to pay its policyholders? So it's great to have that kind of rating. AM Best is probably the best known, and it's been around for a long time. I'd love to have a student go and work for AM Best. I've presented to them a few times on USAA and how we did investments. Really great firm. They feel a lot like a USAA, or the way USAA used to be, where everybody was all on the same campus. One large campus, one large entity, and everybody works together. It's a very, very different than S&P and Moody's. So very interesting. S&P and Moody's, I've seen S&P. I had a really good friend of mine as a life insurance analyst for S&P for a couple of years. Went and visited her, and when I walked into her office, it was just an absolute mess. She had just started, and just papers from her predecessor, papers literally stacked 4 or 5 feet tall, just looked like these stacks of paper that could fall over and cause major damage. She had never analyzed a life insurance company from that perspective, but she knew the industry very well from the projects we had done together at USAA. So she knew the industry well, and so she started S&P, and they assigned her some companies, and she was supposed to do the analysis, and they gave her absolutely no training. And when she had her first report to write, she asked who's going to review this, and they said no one, just publish it. So it's not many people want to work for S&P and Moody's on this side, on the rating side, for their whole careers. They want to move off to a higher paying job that's not quite so stressful and so time consuming. But it's a good experience to get if you're interested in this kind of thing. It is something you could certainly do. But S&P and Moody's, they have their offices in New York and do this type of analysis. And they do have specialized units that do just insurance. And she had just a handful of companies that she did. So what was the process she did? Well, she did an analysis of the firm, a typical fundamental analysis. We'll talk about that. What do you look at? Ratio analysis, looking at growth, looking at capital ratios, a lot of stuff that we've somewhat alluded to in doing the accounting. The rating agencies would meet with the company once a year. I remember those meetings at USAA. There were big deals. It was S&P, Moody's, and AM Best. I can't remember if any of the others did. Weiss is a little bit unique if they're still in business, where they refuse to work with the meet with the company, because their belief was if you meet with the company, it's going to give you biases. It's going to skew your opinion. You need to not have any relationship with the company at all. But meet with the company once a year, and boy, those meetings were intense, and boy, they asked tough questions. Didn't matter if it was the CEO of the company, they would ask very penetrating questions. Our CEO used to hate it. He'd come out of those meetings just furious at some of the questions they would ask. But interesting. We treated them well. We had really good relationship with them. The lady who ran that program, she made them our analysts at these rating agencies her best friends. She wanted them feeling very comfortable calling her for any questions. There is a relationship management for this. Ultimately, the agencies go back to the communities and they make their arguments, so it needs to be as unbiased as possible. But obviously, companies try to build a good rapport. USA's philosophy was share everything. Don't hide anything, because if they get the sense you're hiding something, they're going to downgrade you just because they don't trust you. And so anytime there's a major hurricane or a major event, they would call. If we had the data, we would give it to them. So some firms, that wasn't their approach. Just keep it from the agencies, don't tell them. So just kind of the philosophy. But they go to committee, and the analysts would make their argument for what rating they think this company should have, and they would publish their rating. Now, some people think, well, since you meet with the company, then the committee meets, that your ratings are good just for that period of time. So if you met with the company in November, your ratings are good as November. But the rating agencies say, no, our ratings are always current. Just because we haven't met with the company in a few months, or we haven't had a committee meeting, the analyst is responsible for monitoring that company ongoing. If anything changes, we'll change our ratings immediately. So these are not, they say these are up to date constantly. There's never stale ratings. So what do they look at? Well, their analysis is both quantitative and qualitative. So I remember at USAA, when USAA expanded out to the enlisted market, that was a huge change for USAA. Prior to that, USAA was dominated by the officer market. And the thought was the enlisted market would drive just as well as the officer market. And the thought there was is that if an enlisted serviceman had an accident, especially a DWI or driving recklessly, that they would lose their commission. The military would essentially weed out those bad drivers. So that was the thought. And so USA started growing really fast into that market. And then they quickly discovered that the enlisted market did not drive as well as the officer market. And so USA's claims started going up dramatically. And the rating agencies were very concerned about that. That was a qualitative analysis of, do you guys know what you're doing? You're expanding fast. It was interesting on the life insurance side that the enlisted market was just as healthy and lived just as long as the officer market. So our life insurance company, they wanted to grow fast in the enlisted market because they were getting a very good book of business. Enlisted servicemen, enlisted servicewomen are very healthy people who take care of themselves. They live a long time. So that was a good market. But USAA on the property casualty side, especially auto insurance, just could not grow that market well. So that was a qualitative. They asked those kind of questions. They want to know, what are you doing? The industry looks at the overall industry. So for USAA, there's a lot of concern about catastrophe risk on the property and casualty side. There's a lot of concern about below investment grade bonds on the life insurance side. And so they had certain industry characteristics. The agencies did not like banks at all, and USA owned a very large bank. So that had some impact. So they look at the overall industry. So if the life insurance industry, if they think it's a really weak industry, maybe a triple B industry, You could be a great company in that industry, but if they don't like the industry, it's probably going to hamper your ratings. You're probably going to have a tough time um, getting a perfect AAA rating if the industry itself is considered to be high risk and low rated. Then they get into specifics. Obviously, the most important, we've talked about this already, is capital. Does the firm have enough net worth to cover its risk? And most rating agencies use risk-based capital formulas, just like I showed you with MetLife. Um, so rating agencies have their own formulas. In fact, Moody's at one point called me because I had access to a database and asked me to run their model for all the companies in the U.S. and I was more than happy to do that because it gave me access to their model before they released it to everyone else, and I could try to influence them. I gave them the numbers accurately, but try to show them, here's areas you have concerns and kind of point those out. So S&P and Moody's have their own capital ratios. They don't use the risk-based capital that the regulators use. It's a different ratio, but it's very similar in many ways. So rating agencies should heavily rely on capital. You think that would be the most important criteria? So I was working with our life insurance company, and they were rated AA, and there was frustration. Why aren't we rated AAA? Because our parent company is AAA. Why can't we be AAA? So I ran the analysis, and I ran analysis of ratings to capital ratios, and you would think the capital, the net worth ratios, the risk-based capital, would have a high correlation to ratings. Firms with high risk-based capital, high capital versus the risk-based capital would be highly rated, and those that were low would be lowly rated. And in fact, I did not find a relationship at all. It was completely uncorrelated, and that didn't make sense to me. So what I did is I took the industry and I stratified them by size. I did the analysis of rating versus capital ratios for big companies, medium-sized companies, smaller companies, and small companies. And when I did that, there was a high correlation. So within large companies, firms with higher capital ratios, better capital ratios, had higher credit ratings than firms with lower. And then smaller companies, better capital ratios did better, but the smaller companies had to have a much higher capital ratio to get the same rating as a large company. So at that time, rating agencies had a strong bias toward large companies. It's almost a too big to fail that we hear about banks. They're so large, states are going to make sure they can stay in business. I'm not so sure that's so true as much today, but it was definitely true when I did that analysis, which meant I had to go back to my life insurance company and tell them, based on your size, it's practically impossible for you to be AAA. You would have to be the size of a State Farm or MetLife. If you were their size, you would definitely be AAA because your capital ratios look wonderful, and your capital ratios are far better than a lot of AAA companies, but for your size, not. So this is interesting. If you get in a job like this is one of the first things you want to do is take credit ratings and run analysis of the credit rating versus certain ratios. And don't forget to put size in there as one of your factors that you look at. They look at liquidity. So they're worried about run on the bank. So with the life insurance companies, we talked about this. It's that disintermediation. It's not a run on the bank, but a run on a life insurance company. So interest rates shoot up. Bank CD rates are a lot higher than annuity rates at life insurance companies. People take the money out of the annuities, take it over to the bank. That's what the rating agencies are worried about. They run models, they run a lot of analysis of that just to see what could happen. And in fact, the states that comes up here, the states actually require certain scenarios. And so the liquidity is closely tied to asset liability models and asset liability analysis. Running scenarios, stress testing. If you took my risk management class, that first paper in that class, we talked about stress testing at banks. So major money center banks and probably most major banks do a lot of stress testing. What happens if we go into a recession? What happens if interest rates fall? What happens if interest rates rise? What if the stock market falls 40%? So run through those scenarios. So life insurance companies do that. Their main thing they're testing are interest rates. There's something called the New York 7. If you're an actuary, you'll have to learn these. but there's 7 interest rate environments that the state of New York requires life insurance companies to run against their business. It might be one scenario might be interest rates fall and stay down. One might be interest rates rise and stay up. One might be interest rates rise for a few years and then come back down after a few years, or they fall for a few years and come back up. So you run those New York 7. Most large life insurance companies are doing stochastic analysis, where they may be running hundreds of simulations, all different analysis, and just to seeing in what environment do they do badly and how badly do they do. That was what I showed you when I was talking about annuities being like a short straddle on interest rates. You run several scenarios and you see these annuities really blowing up when interest rates fall a bunch, really blowing up when interest rates rise a bunch, but doing well when interest rates stay pretty stable. So that's a huge part of the analysis of insurance companies, is how well matched are their assets and liabilities so that in the extreme scenarios they can survive, they can still be in business. A huge one is asset quality. Rating agencies are especially concerned about credit quality, the junk bonds in insurance company portfolios. Back during the savings and loan crisis, back before most of y'all were born, or maybe all of y'all were born, back in the 80s, late 80s, early 90s, life insurance companies, some of them had 200–300% of their net worth in junk bonds, and it made regulators really, really concerned. They also worry about concentration, having too much in one particular asset or one particular company, so they do that type of analysis. They want to know your market share and how that has progressed over time. They don't want a firm that's losing market share, slowly dwindling, becoming smaller and smaller, having competitive problems. We've seen on the property casualty side with Progressive and Geico really taking over the market and stealing a lot of market share, especially from State Farm. That makes these companies very, very concerned. They worry about lapse rates. So this is this disintermediation. People are leaving the company to go somewhere else, either leave it to go to a bank or leave it to go to another life insurance company, or just canceling the product because they don't want it. That's the lapse rate. Kind of what you see with Netflix. How many customers do they pick up versus how many do they lose? So life insurance companies look at lapse rates. Extremely important for life insurance because putting business on the books is extremely expensive because you have to do a lot of underwriting, which is very, very expensive. Some of these products are not profitable unless the business stays on the books 7, 8, 9 years. And so if you have high lapse rates, a lot of people canceling the product after only 1 or 2 years, that's going to make the business very, very unprofitable. They like to look at parents and subsidiaries. We looked at it a little bit of that with MetLife. Rating agencies do not like what they call pyramiding of capital. So you look at the net worth of USAA and you say, wow, that's a big number, but then you notice $1 billion of that is the net worth of their life insurance subsidiary. Rating agencies will say, well, you can't count that twice. You can't count it against your life insurance business and count it against your property casualty business. It can only be used, you can't use that capital twice. I think it's a little unfair because another company might actually own an insurance company in their investment portfolio as a, as a completely unrelated, not a subsidiary, and they let you count all of that. So it's a little unfair, but they definitely do not like to count the net worth of subsidiaries as part of the net worth of the parent company. They look at quality of management. Obviously, that's a big part. USA would bring in its top brass to talk to rating agencies, and they would ask questions that, well, we were always worried about one of our senior officers just losing his cool because he got so frustrated with the questions they would ask. One in particular was he thought the only way USA would be AAA rated is if we could withstand a 1 in a million year catastrophe, and that just irritated him. And we really thought they were doing the math incorrectly. Just looking back, how many times AAA companies go in default? Bad math, because AAA companies don't go in default because they're downgraded before they go in default. So you have a firm that's AAA, and then they're downgraded to single A, and then triple B, and then they default. Yeah, very, very few AAA companies actually go in default while they're AAA. So it was bad analysis. But when they asked that question, our CEO got really upset, and they had to kind of like, don't upset them because They go back, they make the case for your company. You've got to keep your cool. You got to make them see that you know the business. You know. Then they look at your underwriting practices. So that was something at USA with the enlisted market. How do you look at that market? How do you know they're the same risk as your other business? With the life insurance company, something they tried to do, I don't know how far they got, but they wanted to see if they could sell life insurance online just through a questionnaire with very little underwriting, maybe smaller products, to try to get more business just completely online. No blood tests, no doctor exams, just based entirely on the application online. The rating agencies were very concerned about that. So underwriting practices is how do you assess risk? How do you know who's risky and who's high risk, who's low risk? Obviously, it's medical exams, it's applications. I wanted to have someone from the USA life insurance company from their underwriting come speak to us, but he had some major family issues this semester, so just couldn't do it. But it's interesting. He presented to my class a couple of years ago. Very, very interesting. And he's actually a heart surgeon. He retired as a heart surgeon, decided to have less stress in his life. And USA has an actual PhD doctor as part of their underwriting practices. So he could look at things like EKG machines and other things related, obviously, to heart ailments and really help them understand, should this person be considered a substandard risk, or should they get normal rates? So that's something insurance companies have to do, and it's working very closely with the actuaries to understand when should we price more, when should we price less, who gets our best rates, who gets our worst rates. And then one thing that is interesting here is growth. They want to know how fast is the business growing. So we looked at MetLife. You can certainly look at that by product and just look at their premiums and see how fast their premiums are coming up. A business that's not growing or growing too little, that's bad news for rating agencies. But they're also concerned about a business that's growing too fast. That's where they dinged USA for moving too fast into the enlisted market. Growing too fast, especially on the property casualty side, but on the life insurance side too. 2008, there were some companies on the life insurance side selling a lot of annuities. Remember, annuities are very, very dangerous when interest rates move down a bunch or move up a bunch. And so you put that much business all in 1 year, boy, that's a lot of growth. And then that business is all kind of locked in with different types of crediting rates and guaranteed minimums. Boy, that's a scary business to have that much business sold all in 1 year on such a dangerous product. Remember this product with like a short straddle. Very, very dangerous. Does really horribly. Interest rates move a bunch, and especially if you load up all in 1 year, boy, it can be really, really dangerous. So there's things, if you're going to interview with a life insurance company, I would definitely keep this list handy and do as much of this on your company that you're interviewing with to understand these type of analysis. Or maybe this brings up a question. If you're interviewing for the company, say, well, I'm really interested in your asset liability modeling and analysis, what kind of scenarios to do, what kind of stress testing you do, what do you consider your worst case scenario. Those would be really sophisticated questions to ask. All right, so one last topic here, insurance regulation. So let me set this up. So insurance is regulated by the states, not by the federal government, and yet banks, especially large banks, are regulated by the federal government. Why in the world is that? Well, it goes back to the U.S. Constitution and then some history. But the U.S. Constitution says anything that's not specifically spelled out for the federal government is reserved for the people and or the states. So the question is, that the U.S. Constitution specifically give the federal government responsibility for regulating insurance. And so I love reading the Federalist Papers. I try to read them once a decade. They get a little dry reading them. But I like to just be reminded, one thing that's pretty crazy with the Federalist Papers is how little the government was supposed to do. Um, so what are the powers for the federal government? And here they are. National security, regulation, or essentially commerce and regulation with foreign nations. Number 3, the one we're interested in, maintenance of harmony and proper intercourse among states. Certain miscellaneous objects of general utility, that is the one that's just mushroomed. Restraint of the states from certain injurious activities, and provisions for giving due efficacy to all these powers. So there's only 6 things our federal government's supposed to do. Over time, that's just mushroomed into a whole lot of things. Things like Medicare and Social Security that we've been talking about. But number 3, maintenance of harmony and proper intercourse among the states. So specifically, what are we talking about that? Well, this part of James Madison's Federalist Paper number 41 got into the Constitution through Section 8. Congress should have power to regulate commerce with foreign nations and among the several states and with the Indian tribes. So what this is saying is anything that's commerce, where the commerce goes among the states, the U.S. federal government is supposed to regulate that. So it seems like a slam dunk, right? Insurance is commerce, and insurance companies sell in multiple states, so obviously the federal government should be regulating insurance. And the other thing they had is Amendment 10, which most people forget. Powers not delegated to the federal government, nor prohibited to it by the prohibited by it to the states, are reserved. Everybody says reserved for the states. Every time I ask a class this, I say, it's reserved for whom? And they say, oh, to the states. And then they forget this last part, are to the people. It's like we've given up all our rights. But if the federal government can't do it, then the states have the right to do it, or everybody just leaves us alone and we can do what we want to as people. So if insurance is not commerce, or if it doesn't cross state lines, then regulation sticks with the states, or it's just not regulated at all. We regulate ourselves. So there's the question. So interstate commerce is a federal government duty. Is insurance interstate? Inter, not intra, but interstate. Does it move between states? And definitely MetLife, USAA, Prudential, New York Life, they do insurance in all 50 states. So there's no question there. Is it commerce? Banking is definitely commerce, but is insurance commerce? Well, most people say, well, obviously, yes, except in 1869, there was a famous Supreme Court case. This guy named Paul was suing Virginia, and his argument was Virginia is requiring all these regulations on me to sell in Virginia, and I'm not from Virginia. I think Paul was from New York. So Paul wants to do business in Virginia, being a resident of New York, and Virginia's putting all these restrictions on him, and Paul says, you can't do that, Virginia. I'm involved in interstate commerce. Only the federal government can restrict my activity in your state. You can't do that. And the Supreme Court came out in this case and said insurance is not commerce. Now, when you read the actual discussion, it's a very interesting discussion. It doesn't really make sense to me that would be the case. Some of this is that states that already started regulating insurance, so some of them figured, well, they've already started, let's let them keep doing it. But it really doesn't make sense that they would consider banking to be commerce, but insurance not to be commerce. They did discuss some about it not being a physical good, and it's only being a promise. But to me, I don't know how you can get around that. That definitely is commerce. So what happened here in 1869? Now you've got the states with authority to regulate insurance, and now you got someone like poor Paul who wants to sell insurance in several states, 13, 14, I don't know how many states we had in 1869, but go sell insurance in all 20 states. But now he's got to deal with 20 regulators. There's no way. It's going to be too expensive. It's going to make the U.S. insurance market uncompetitive versus other countries. It's going to be a disaster of our whole federalism process of multiple states, but one federal government. And so 1871, the National Association of Insurance Commissioners was created, and their goal was to try to figure out how to streamline the state regulations so that insurers that are in multiple states do not have to deal with so many regulators. So it created uniformity between the states. It made uniform the accounting through the statutory statements that we just looked at with MetLife last class. They created several model laws. We've seen that one, the risk-based capital model law. I think I gave you actual copy of that on Blackboard. Their worst failure was the model investment law. They moved from what most states had, which is a principled law, which are general rules for investing, and they went to a very pigeonholed law, detailed rules. Oh, what a mess this was. Risk-based capital was probably the best thing the NEIC ever did, and the model investment law is one of the most ridiculous things they've ever did. In fact, at one point, they had this law that went on for 60, 70 pages, but it's for life insurance and property casualty together. And someone says, well, we can't have the same law for life insurance and property and casualty. We should have separate laws for each one of them. And so what they did is they took the entire thing and they called it life insurance. They copied it, repasted it at the end, and then called this one for P&C, and they made very few changes. So it ended up going from, say, 60 pages to 120 pages, and is exact same wording almost twice. They should have made it all one law. The regulators sent me the law, their draft law, and had me run it through the database we had. USAA was one of the few companies that both had access to all of the financials for all the insurance companies and had a resource like me that my boss said I could work for free all weekend to do this analysis. And so I took the law, and what I found with the law is that I think it was either 60 or 70% of the industry, life insurance industry and property and casualty industry, failed the law. The regulators, before they sent it to me to look at it, they said, one regulator said, we're not changing this. This is it. This is the final draft. All we're going to do now is fix any obvious errors. After they saw my analysis where, they're essentially going to have to shut down 60 to 70% of the industry, they backed off really fast and the law essentially crumbled. I don't know where they are today, how far they got. It was interesting. My boss actually had me and one of my peers go and read the investment laws of all 50 states and summarize them. And most of them are on this principled base, where they just had general rules, high-level rules of how to invest without specific rules. But that's what the NEIC does, is it develops these laws, and then they try to get all the states to adopt them. So they go state by state, each state legislature. So the NEIC does not have authority to require states to do anything. They actually tried to get that authority by saying, if you did not take our model laws, we're not going to credit you as a state, and therefore your regulators in your state, their reviews will not be accepted in other states. That was challenged in courts, and I don't think it worked too well. So the NAIC really doesn't have much teeth. All they can do is encourage states to adopt their laws. They do a pretty good job of getting most states to adopt their model laws, especially the risk-based capital. It went through and got approved very rapidly because of the environment is during the savings and loan crisis. Insurance companies lobbied hard, got their legislatures to pass that law, so that worked pretty quickly. And most states adopted it exactly as it was proposed by the NEIC. They have many laws related to market conduct, how you treat your customers. We'll talk about those. So as of 1871, states are regulated insurance. The NAIC is trying to bring that all together. And then 1944, the Southeastern Underwriters Association is suing the U.S. government. This is really important. When Paul did his lawsuit, he sued a state, Virginia. But this is not an insurance company, but a trade organization suing the U.S. government. And what the U.S. government was trying to do, Southeastern Underwriters was providing pricing information to their members, and the U.S. government saw that as collusion. They said, you can't do that. You can't set your prices in tandem with somebody else. That's collusion. And so they were going to make that a violation of antitrust. The Southeastern Underwriters says, well, wait a minute. insurance is not commerce. The federal government has no authority to regulate us. Therefore, we're going to sue you. And the Supreme Court overturned Paul versus Virginia, and they decided insurance is commerce. And so in 1944, we had a serious problem. We had an entire industry that needed to be regulated, but it didn't have any regulators because now the Supreme Court has said only the federal government can regulate these companies. Very, very important law, the 1945 McCarran-Ferguson law. It passed in Congress very fast. So Congress moved fast, something we don't see today, except for maybe the 2016 tax bill. It's rare to see Congress and the president all come together and get something fast, but they did it back here, even though it's during a time, we're coming out of the Great Depression, World War II, but still Congress moved fast. So McCarran and Ferguson, two members of Congress, what they said was, okay, Supreme Court, you say we, the federal government, are required to be the ones to regulate the insurance industry. However, there's nothing in the Constitution that prevents the federal government from outsourcing its responsibilities. The federal government can hire other agencies, other groups to execute. They're still responsible for it. The federal government's still responsible, but they can hire someone else to do it. So essentially what the McCarran-Ferguson Act said is U.S. Congress is responsible for regulating life insurance, and we're going to delegate that or outsource that to the states. They will execute it. We will only come into play if we disagree with how they're doing it, and we can fire them and hire somebody else. So essentially, they left the entire structure in place without any changes by this kind of magical trick. So that's where we are today, and we're still here today. We talked about some exceptions to this. So, the biggest exception we talked about down here is on those products. We talked about variable life, variable universal life. Anytime the word variable was in there, we talked about this early in the semester. Anytime you see that word, the SEC actually regulates those because they're investments. It's no longer insurance, they're now investments. So they're regulated both by states and federal government, regulated by the states as insurance and regulated by the SEC and the federal government as investments. That's the one big difference. Some changes and challenges to McCarran-Ferguson. USAA was a big player here. USAA at one time was pushing really hard for an optional federal charter. So essentially, insurance companies, they could be regulated by the state, but if they'd like to, they get a federal charter, exclude them from being regulated by the states, they can be regulated by the federal government. USAA was a big proponent of that. Bob Davis, the CEO, hated state regulation. Very few other insurance companies were on board with them, and USAA was about the only one. I don't know what happened after Bob Davis left USAA, if anyone took that up. I don't know, Joe Robles, when he came in, if they pushed that. I doubt he did. The fear companies had with the federal government is that the federal government would take over things like solvency and some market conduct kind of things, but they would leave pricing with the states. And so that was the thing USA hated the most, was especially on the auto insurance side. They couldn't charge the rates they wanted to charge because of the heavy state regulation. So the fear was the federal government would take over stuff that the insurance industry didn't want them to take over and make it much more strict, and then leave to the states the stuff that the states were making really horrible, and ended up with the worst of both worlds. So the other insurers are saying, we know what we have with the states. Let's stick with that. It's horrible. We don't like it. But who knows what's going to happen It would happen if we open up all of this to the federal government. And I think that's generally the view. So yeah, we'll have the states regulate pricing and market conduct, and feds regulate solvency. Just the worst possible. Small insurers tend to love state regulation. It's the big insurers that have just gotten used to it, and it's not inexpensive. When I was at USAA, they had regulatory departments that were, 50, 100 people, just massive departments. So it's very time-consuming, very expensive to do with all 50 states. If you want to introduce a new product, You have to get it authorized in each state that you do business in. And so it's just, yeah, it is definitely 50 states. Even though the NEIC has tried to make it more uniform, there's definitely still a lot of hassle with dealing with all the states. So the last reform bill, and in fact the Affordable Care Act that you've been talking about in your paper too, there's a reform bill after the Glass-Steagall was taken away. There's a reform bill to try to merge regulation for insurance and banking close together. It did not really overturn McCarran-Ferguson. It just made a few overtures to it. And then the Affordable Care Act, I remember seeing President Obama on the news, and President Obama was saying, we got to end McCarran-Ferguson. And his frustration was health insurers were protected from a lot of the antitrust regulations because of McCarran-Ferguson. So he wanted to overturn it, but it did not get overturned. So another battle. When I was at UTSA in the early 90s, after the savings and loan crisis, there was actually a bill before Congress to overturn McCarran-Ferguson. The Dingell Committee, and it looked like it was going to pass. It had all the votes, it was going to pass, and then something happened, they got distracted, and it just dropped. But there's always a risk there, and the state regulators are pretty aggressive in protecting their turf, so they'll go after it. But that's where we are today, and it's still in place. States regulate insurance companies. So if you're an actuary and you're doing pricing, not only will you be pricing products, but you'll be pricing products for your assigned states. There's tough states to deal with, like Washington, California, Georgia, Hawaii. There are certain states that are just tough. Florida's horrible on the homeowners insurance side. And so if you're an actuary, there's some states that are a piece of cake. They're easy, whatever you file. Like Texas is pretty easy to deal with. Whatever you file is easy. Now that is on the property casualty side. So what about the life insurance side? So what do regulators actually regulate? They regulate solvency, how much capital you need, and pricing. They want to make sure your pricing is adequate. The life insurance side, the main thing you see from the regulators is on market conduct. It's how the companies treat their customers. So there's a few things that insurance companies are really bad about. I'm trying to actually sue a life insurance company right now for doing some of this stuff to a policy a relative of mine has. I'm having trouble finding a lawyer, but I think it's a pretty grotesque activity. But churning and twisting, that's when they try to get customers to change products just so they can get the commission. So they churn the product, they turn it over so they can get the commission, they twist stuff around, they use some pretty deceptive advertising. So twisting is vanishing premiums. We didn't talk a whole lot about that before, but definitely vanishing premiums on universal life, saying, hey, there's a good chance you won't have to pay premiums at all after 20, 30 years. That you've made so much money on your policy, you can just let the cash value pay all your premiums and you're fine. That's actually the case I want to bring, I want to sue on, is the vanishing premium and the twisting and churning that they did. You already saw with equilinked annuities, the twisting and lying that goes on with that product is pretty incredible. So regulators set requirements for what needs to be disclosed to the policyholders, what the time limits are, how quickly you have to pay claims, how quickly you have to settle, what advertising and marketing you can do, what you can and cannot say, policy features, what you must have by law, certain policy language is dictated, rebating of premiums, that's more of a property casualty side. It's illegal in many states, but I've never understood why. But rebating, we actually had a debate in this on my property casualty class because it's much bigger there. But rebating is an agent gets a $200 commission for selling a product, and they tell the customer, hey, you know what, I'll give you $50 of my commission if you'll buy this product. So there's a lot of debate how that actually even harms a policyholder. They get 50 bucks. What's the issue there? A lot of this market conduct started in the early 1900s with Teddy Roosevelt, and a lot of this, a lot of regulation try to fix bad business practices. But it tends to be much more of a life insurance issue than a property casualty issue. Another thing that's regulated is pricing. This is much more of a property and casualty issue, which is really interesting because life insurance is much more uncompetitively priced. You're much more likely to get ripped off on life insurance pricing than you are on P&C. I always say if you're going to buy life insurance, go to at least 5 different companies. I would make USAA one of them just because I know USAA is usually very competitive. MetLife might be one. Uh, Prudential, New York Life, some of the big guys, Northwestern Mutual, have some of the big guys, and that's why we talk. If you're buying 10-year level term, 20-year level term, it's very easy to compare rates. Just take the one with the best rate. It's very, very simple to do. Property and casualty side, that's where it tends to be much more regulated because auto insurance is required by law. Homeowners insurance is usually required if you're going to have a mortgage on your house. So because it's required, people have to have the insurance. Regulators have stepped in to watch it, although I think there's far worse pricing going on the life side than the property casualty side. But one thing they look at, or 3 things they look at, is it adequate? That falls under solvency. Are your premiums high enough that you're not going to go out of business? They want to make sure it's not excessive. This comes into anti-competitive activity. In my property casualty class, we talked about the Herfindahl industry and index. How concentrated is the industry? Property casualty and life do not tend to be really anti-competitive businesses. They don't tend to be overly concentrated in states. The property casualty side in a few states is pretty heavily concentrated, but most of all, throughout most of the country, you have plenty of companies to pick from, and they're pretty competitive with each other. And then the last thing is insurance cannot be improperly discriminatory. That applies to both P&C and life insurance, but it's much more heavily regulated on the property and casualty side. So can you charge men more for auto insurance than you charge women? The life side, charging men more than women, women more than men. On health insurance, life insurance, on annuities, that's pretty straightforward. It's pretty straightforward on auto insurance side as well. Life insurance discriminates against smokers, discriminates against people with a family history of certain diseases. The one place life insurance is not allowed to discriminate is with the some of these DNA cell research to see what your DNA is telling you. So there's heavy laws related to that. But life insurance can discriminate on quite a few things. If they can find a relationship, they're able to discriminate on it as long as they can show that the data supports that pricing difference. So that's it for regulation. You can certainly look these things up. If you're going to interview with a company, you really need to know about the McCarran-Ferguson Act. You need to know what regulators do. They regulate solvency, market conduct, and pricing. Know a little bit of the history of the regulation from insurance companies. Know that it's extremely important and that it's all 50 states. So that's important going into an interview to understand the complexity of this industry. All right, so that's it. That's our last class, except for we're going to do the exam review in the next class. So you should have a really strong understanding of this industry now. Should go into an interview with great confidence. I gave you some stuff that's pretty negative on this industry, so be careful of that when you're interviewing. But try to find an ethical company and go and work for it. And if you find one, work for it and give them your all, because it is a great industry with a lot of complexity and really interesting things to sink your teeth into. So that's it for this class. Thanks.